This is Financial Standard, the definitive source of news, thought leadership and analysis for Australian wealth management professionals. Financial Standard. Take the lead.
Hello, everyone, and welcome to the Financial Standard podcast. My name is Eliza Baven, and I'm a senior journalist here at Financial Standard. Global equities have continued to outperform despite sticky inflation, geopolitical tensions, ongoing wars, tariffs, and trade issues. It's been good news for investors and portfolios, but can it really be sustained? To discuss more, I'm pleased to welcome Talaria Co-Chief Investment Officer Chad Padowitz to the show. Thank you for joining us, Chad.
Thank you. Thanks for having me.
So let's start off with why have equities had such a stellar run? It really feels like nothing can stop them.
Yeah, look, they have had a very good run, and it's been for quite a long time as well. It's been a very long, secular bull market over the last 20, 30 odd years. And if one thinks about what drove that, you actually have to go all the way back to when China entered the global economy, brought globalization, lower wages, more of a consumer market, as well as using their excess savings to help drive down interest rates. So you had a combination of increasing margins, increasing cash flow growth, alongside lower cost of capital, which allowed margins to expand, PEs to expand, and broadly equities to do very well. Now, that's obviously over the last, several decades. More recently, what has helped is you have had certain policies from the US administration, which is lowering taxes, bringing capex onshore, as well as some level of deregulation. And all of that is happening in an environment with some lower interest rates as well, which is fueling the sentiment for, cyclical growth, combined with what we're seeing is continuation of structural growth, particularly AI, the Magnificent Seven. So all of those things have combined to drive to what is actually right now probably the most expensive or amongst the most expensive equity market in history.
Well, yeah, on that, as you kind of say, if equity markets have just kind of grown and valuations getting so much higher, are equity markets now at risk of being in a bubble?
Well, certainly a lot of these dynamics that have been very supportive are actually going the other way. So we are seeing deglobalization, we are seeing higher and stickier inflation and higher interest rates. So we definitely see some headwinds ahead of us. We also see high levels of expectations of earnings, of approximately 13% growth on the S&P next year on top of a similar number this calendar year. So we certainly see high levels of expectations alongside high valuations, which also embed high margins. All of that certainly creates a fair level of frothiness. Whether it's a bubble or not, it's really a function of the expectations one looks to achieve going forward. So if you're happy to achieve a very low long-term return, I guess you could say the markets are broadly not overvalued. But if you do expect them to reprice into a more normalized return structure, well, I do think we do have quite some risk ahead of us.
Well, yes, I was going to ask you now kind of what your thoughts on what's changing in the market, because you wrote a really interesting op-ed for FS Super, and I suggest our listeners go take a read. It's very interesting. But you were kind of saying that valuation is really going to start mattering again over a period of it not really mattering. So is that one of the major things that you think is going to be important for investors now?
Yeah, well, ultimately valuation is sort of the inverse of the kind of the earnings yield. So if a company is trading on, let's say, 40 times earnings, that's got an earnings yield of 2.5%. Now, if you're growing 10, 15, 20%, well, then it doesn't really matter that because your earnings growth are far exceeding the the valuation challenge. But if you do get, which is happening, the law of large numbers in some of these large companies, the economy is not delivering likely the level of sales growth that you would need. So I think you do have a requirement for that earnings yield to go up. So to get your return, which is the other way of saying valuations have to come down.
And so how can investors kind of prepare for and capitalize on this switch over to valuations, becoming more prominent?
Well, a few things. One is if you think earnings growth is going to be more challenged going forward, or certainly not going to be as easily achieved, which we think is a fair, prudent assumption to make, well, then you would, alongside concerns which we haven't touched on, there is quite a significant global debt problem in the world. We can touch on that if you wanted to, but broadly, if you combine the valuation, the late cycleness, the inflation dynamic we have at the moment, alongside the late cycle debt problem we have, that does lead to a playbook that we think is best used to attack the investment markets. And one of that part of the playbook is lower duration. So effectively be closer to your money, get your money back quicker. That would be companies generally that are more value-based, more higher free cash flow yield. So lower duration is one. Real assets is important. So companies that actually would benefit from inflation staying sticky, the companies that have high levels of property and equipment, manufacturing type businesses could be that. Real assets could include gold and things like that as well. Also, good balance sheets. In a world with a lot of debt, you don't necessarily want to be the one looking for more of that. You'd rather be the one that has your own capital and not dependent on markets for that. So good balance sheet's good. And then lastly, which is often said, but I think it's more important now, is a diversified source of return. In a world that's quite expensive, uncertain, the likelihood that you can have a high level of confidence on what will provide you a good return going forward, you would be less confident in. Because of that, rather look for different ways or more ways of making a similar return. So diversify your source of return, we think is a very important thing to consider at the moment as well.
Well, also going back to that debt issue that you brought up, I mean, the US at this point is drowning in debt. I mean, I would, obviously this has been going on for, as long as I can remember, the US has been drowning in debt, but it has, the level of debt the US is carrying now has gone up so exponentially, it almost seems impossible to turn around. And yet, US markets, US equities have continued to go from strength to strength, regardless of the debt, regardless of what US President Trump says or does. Can we expect this to continue, or are all these factors going to start weighing on US markets? Because obviously US markets have such an effect on the rest of the world's markets.
I think the debt problem will weigh eventually, and maybe sooner than later. One can never really know when that actually starts to hurt. The reality is, if you look 20 years ago, the US was in a lot better situation than it is now from a debt point of view. So while then it looked historically quite high, now with the benefit of hindsight, that looked pretty good. So one of the reasons you should feel that it will impact is, for instance, the US spends more on interest on debt than it does on its defense budget. It spends over $3 billion a day just on interest. Now, that money isn't going into the economy as such. It's not buying, it's not paying for things. It's just paying off interest, which a lot of those are obviously foreign holders. And because of that dynamic, the high interest payments, the discretionary spending as a proportion of the total government is actually quite a small number now. It's under 30%. It used to be about 70%. So their ability to cut the deficit's very, very difficult. So it's likely that the debt problem will keep getting worse. The interest costs will keep getting worse, which will crowd out investment. It will crowd out all kinds of things. And, these things do lower growth rates, do lower productivity. It's not a complete surprise that the last, most economic recoveries in the last several decades have been weaker and weaker than the ones preceding them. So although the equity market is hitting all-time highs, the reality is the economic growth of the US has actually been on a downward trend in terms of its growth rate. And part of that is the cost of carrying this much debt eats away at the productivity and growth rate of the economy. So, it is going to keep getting worse. We don't quite know, is there an actual moment that the market reacts violently? Cannot predict that, but we certainly know that it's the direction of travel isn't supportive.
Okay, so then looking ahead to 2026, because I can't believe it's November already. This year has flown by and we're about to go into 2026. So for investors going into 2026, what should they be looking out for? What should they expect? What should they avoid?
Yeah, look, as I mentioned, the growth rate expectations are pretty aggressive for 2026, around 13%, certainly at the S&P. It's not in every sector. Certainly margins are quite high. So I would, as a general rule, if you're looking at a company that's got record high margins, high level of growth expectations, and a very elevated valuation, now, yes, they may obviously deliver on all of those things and you can get a good outcome, but your avenues of disappointment are quite extensive, and the pain in the event of that disappointment can be quite painful. So I would stick away from companies. I'd certainly be concerned and extra careful around those. I think the opportunities are broadly where the market hasn't, fallen in love with. So companies that haven't had the momentum and narrative, we would think companies in the global pharmaceutical space, which are trading at about a 50% discount to the broader market, where historically they've traded at far, far lower discounts, if not negligible discounts. We think insurance is a pretty good space. And, we certainly think companies that are less economically exposed, less interest rate exposed, and less inflation exposed stand you in a far better chance to deliver a decent outcome, if some of these risks start showing up into the equity market.
Okay, well, Chad, thank you so much for joining us today. We really appreciate it.
No, you're welcome. Thank you for having me.
Thanks for listening to this Financial Standard podcast. For more information, visit financialstandard.com.au. Please keep in mind that the information discussed in this podcast is general in nature and does not consider personal circumstances. Reliance should not be placed on any content without further independent financial research and advice.